Want to buy some secret stuff? Want to engage in a transaction with some other consenting adult that you don't want the government to know about? That is easier now, thanks to Freedom 2.0, which brought us something called Bitcoin.
Bitcoin?
Bitcoin.
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 Bitcoins.
Bitcoin.
Bitcoin is a $2 trillion asset, and 99% of it earns absolutely nothing. It sits in wallets, in corporate treasuries, and on exchanges, not earning a coupon, not paying a dividend, just sitting idle. So if you own Bitcoin, part of that idle $2 trillion is yours. And if you don't own Bitcoin, this is still what your portfolio starts to look like in 5 years. So pay attention. Bitcoin grew up. It went from internet money to a real institutional holding. We've got spot ETFs, real custodians, and serious institutional allocation. The asset matured. But Bitcoin has one weird problem that stocks and bonds don't have. It doesn't pay you anything to hold it. No interest, no dividend, no coupon payment. Now picture an institution sitting on $1 billion in BTC. That's $1 billion of capital doing nothing. You might think, what do institutions actually do with idle Bitcoin? The big holders, like miners, corporate treasuries, family offices, they treat BTC like inventory. An inventory that sits there earning nothing is dead weight on the balance sheet. So they already use covered calls for premium income. They already use hedges for downside protection. None of this is new to them. But the standard playbook doesn't get them the yield they actually want. They could sell, which triggers capital gains. They could lend on some anonymous DeFi protocol, which compliance won't touch. They could try Bitcoin restaking through Babylon, Solve, or Lombard, but that's a crypto-native path, not regulated fixed income. None of those land for a serious institutional allocator. So the question is, who's building the rails for this? There's a company that spent 5 years getting the licenses to make this legal. A DARE license from the Bahamas, segregated wallets at BitGo Bank and Trust, and their own tokenized treasuries, private credit, and money market funds that the BTC Yield deploys into. This company is called IXS Finance, backed by Coinbase Ventures, and the BTC Real Yield is a fully licensed product running on Rails the IXS team already built. Now, there are 3 layers to this thing, and each one feeds the next. First, the collar. The institution locks their Bitcoin and sells a call against it at $140,000. So if BTC blows through $140,000, the buyer takes it. But the institution gets paid a premium upfront for giving up that upside. Now, they also buy a put at $55,000. So if Bitcoin crashes, they don't get wiped out below $55,000. The whole thing is like insurance with a payout. The call premium helps pay for the put protection, and the put gives any lender a guaranteed floor on the collateral. Second, the loan. With the floor in place, IXS unlocks USD liquidity against the Bitcoin at about 50% loan to value. So roughly 55,000 of stablecoins for every $110,000 of BTC posted. Now, why does the cost work out the way it does? Because the collar already protects the downside. The lender knows where the floor sits on the collateral, and the net call premium from the collar covers the actual interest on the loan. So for the institution, the end result is a 0% interest loan. The Bitcoin itself never leaves segregated custody. So the lender's protection isn't a legal promise, it's the structure. The collar sets the floor, custody holds the collateral, and the institution gets working capital without selling a single satoshi. Third, the yield. The institution takes those stablecoins and deploys them into real-world assets, like Fidelity money market funds, private credit, or tokenized US Treasuries through Franklin Templeton's Benji. That's how they earn 4 to 10% APY on capital they never had to sell. 3 layers: and the Bitcoin never leaves the institution's balance sheet. If that feels abstract, here's the analogy that made the loan piece click for me. Think about a paid-off house, right? You can sell the house and have cash, or you can take a home equity line against the house and have both. The house keeps appreciating, but the credit line gives you working capital. BTC Real Yield does the same with Bitcoin. Except the cost of the credit line gets subsidized by the option structure on top, and the cash gets parked in money market funds instead of a renovation. But is this thing actually regulated, or is it just an offshore DeFi protocol with a marketing wrapper? It runs under a DARE license from the Securities Commission of the Bahamas. Now here's why that license matters. DARE lets IXS handle both crypto and securities under one roof. Most platforms can only do one or the other. So IXS can custody Bitcoin and deploy stablecoins into regulated fixed income products in the same stack. And the BTC itself sits at BitGo Bank and Trust, which is an OCC regulated, federally chartered digital asset trust bank in the United States. So the Bahamas license handles the product layer, and a US federally chartered bank handles the coins. KYC, AML, and securities compliance are built into the stack, so the licensing is real and the risk is contained. But how does IXS Finance make money from all this? They charge a small fee on every dollar that gets deployed into real-world assets. So every time an institution moves stablecoins into Fidelity funds, into private credit, or into tokenized treasuries, IXS takes a cut. That's the platform revenue. And as the Bitcoin inventory parked in this system grows, the fee base grows with it. And 20% of that revenue gets used to buy back IXS tokens on the open market and burn them. So the total supply of IXS tokens shrinks every time the platform earns. More usage is more buybacks. More buybacks is less float. This means the people holding the token get something out of the platform's success, not just the institutions using it. But here's where the story gets bigger than Bitcoin yield. BTC Real Yield is the headline product, but it's not the whole company. The actual thesis is that IXS is building the regulated settlement layer for AI agents. So picture autonomous software running on behalf of a treasury or a fund, making capital decisions in real time. Where does that agent legally hold its money? Where does it deploy into a regulated money market fund? Where does it custody a tokenized treasury without breaking compliance? Today, nowhere. There is no regulated rail for an AI agent to act as a capital allocator. But IXS is building that rail. They already have a product called IXS Agent in early access. And it's the first regulated RWA investment layer designed for agents instead of humans. So the BTC Real Yield product you just heard about, that's institutional humans plugging into the same stack that agents will use. Same custody, same compliance, same deployment plumbing. And that matters because in 5 years, a lot of the capital deployment decisions happening across treasuries and funds are not going to be made by a person clicking a button. They're going to be made by software. So whoever owns the regulated layer that software plugs into, they own a huge piece of how money moves. But why is this all happening now? And why is it happening so fast? First, the regulators finally caught up. MiCA in Europe and recent US updates opened the door for compliant BTC yield strategies that didn't legally exist 2 years ago. Second, the institutional BTC supply is real now. Over 1 million Bitcoin is sitting in corporate treasuries waiting for something productive to do with it. And third, the demand is there. 83% of firms told Coinbase and EY they're growing crypto exposure in 2025. And most of them want fixed income returns, not lottery ticket altcoin trades. So you have regulation, supply, and demand all lining up at the same time. That's how a new financial product actually gets born. But what does this mean for you and your money? Bitcoin is shifting from a pure speculation instrument into a yield-bearing balance sheet asset. That's a structural change. Banks, family offices, and asset managers treat assets that produce income very differently from assets that just sit there. So, when Bitcoin can produce regulated fixed income against itself, it stops being a side bet. It becomes a working asset. But BTC Real Yield is gated for US retail. Non-US retail can access IXS open vaults today under the DARE license depending on your jurisdiction, so check your local rules. And if you're sitting in the US like a lot of this audience, the door is closed for now. So why should you care when the door is closed? Because rails get built institution first. Retail rails tend to follow. So pay close attention to what IXS Finance is building for institutions today. I don't know exactly which form the retail version takes, but the historical pattern is institutional first, retail follows. So eventually this shows up in your accounts. Now, I'm not a financial advisor, and none of this is financial advice. And never take financial advice from a random guy on the internet. But I personally think the retail version of this is where the real shift lands, because that's when the average Bitcoin holder stops being a passive bag holder and starts being a yield producer. But I could be wrong. Maybe the institutional version stays gated forever. Maybe regulators close the window. Maybe Bitcoin's volatility makes the collateral math break in a way nobody's pricing yet. What I do know is that the rails are being poured right now. IXS Finance is one of the first concrete builds, but the broader move is the part to watch. Because when Bitcoin becomes a working asset instead of a static one, that changes how every institution and eventually every person thinks about holding it. But now I'm interested in what you think. Are you bullish on retail BTC yield products eventually opening up? Or do you think this stays a closed institutional game? Let me know in the comments down below. Do not forget to share, like, and subscribe. Thanks for watching. Until next time.